As always, we've got a great webinar in store, and I look forward to going over today's topic, which will be our market update for Q4 2025. As always, I appreciate everyone sending in their questions ahead of time. That definitely helps shape the content that we will cover. And also, throughout today's webinar, if you have any additional questions, please submit them in the chat feature. We'll do our best to cover them throughout the presentation. And also, we do use those questions for future podcast episodes. So encourage you all to check out those podcasts and the video too that we also publish to YouTube for those podcasts. Well, let's talk about the markets. This has been an interesting year, to say the least. We started off well in the overall indices that we track, and I've got 8 of them here on today's presentation, on today's webinar, and they represent various asset classes, and you can see similar patterns or similar trends among these asset classes, and these pretty much represent equities or stocks, the component of the portfolio that's going to provide growth over time. It's going to outpace inflation. That's why we track stocks, because inflation is the silent killer of your purchasing power. Over time, things cost more. We've definitely experienced that over the last several years, and we want to make sure that we have investments in the portfolio that are going to allow you to maintain your standard of living as you progress into and throughout retirement. But when you look at this chart, you see, as I mentioned, we started the year off pretty well, and then in March we had a lot of the discussion around tariffs and the uncertainty around, well, how are those tariffs going to shake out? Are we going to have some clarity on the amount of the tariffs, how they're going to apply, who they're going to apply to? And it was changing by the day, and the market's reacting to that fairly negatively. And then we got the announcement that the tariffs were put on pause to allow for negotiations, and then the markets rallied from there. And it's been a very strong rally since those lows in early April. But I think one of the surprising things this year is the best performing asset classes, and currently they are the equities or the stocks that are headquartered outside of the US. So the 2 best performing asset classes are emerging markets and international stocks. So emerging markets, those are companies that are headquartered in developing countries, and then the international stocks are companies that are headquartered in developed countries. The next best performer we have is the NASDAQ, which has a higher weighting to technology, followed by the S&P. Then we have small cap stocks, so those are smaller companies. Then the Dow. Real estate has done okay this year, even with everything that's been going on. Now that's a lot more of the commercial real estate is what that's going to represent, followed then by commodities. These are the sectors of the S&P 500. There's 11 sectors, and I always like to talk about the sectors because the sectors, they do different things at different times. We break the market down into, or these stocks or these companies into a lot of different categories and subcategories to really put together a diversified portfolio, so we get exposure to different things, because they perform differently at different times. So from a sector standpoint, Technology is the best performing sector, followed by utilities. People think utilities are these sleepy companies, and they're regulated monopolies, and so there's limitations on growth. But utilities, again, they perform differently than than other asset classes, depending on what's going on in the economy and investors' outlook for the future. Because they're regulated, you can be fairly confident that they're going to continue with their business operations, and a lot of them pay dividends, but they can be more defensive when there's more uncertainty. So capital or money sometimes flows into utilities when there's more uncertainty, and when that uncertainty picks up, sometimes you see capital leave more of the discretionary sectors. And the consumer discretionary ETF, which is this XLY, it's up 6% this year. And think about that. It's like, well, what is discretionary? Well, discretionary is businesses or companies that create products and services that aren't necessary. Utilities, people are going to pay their light bill as best they can, if all things being equal, but they may not go out to eat. That's a discretionary expense. They're going to go shop at the grocery store. They're going to go buy health care. Those are considered staples, sometimes. Whereas discretionary expenses, going out to eat, going on vacation, traveling, less likely to happen in a economic contraction or a recession. So again, that's what all these sectors, they all represent these different components to the economy. And the way I like to think about it is like, well, how do people spend their money based on what's going on? And that's how we can group these stocks. Now here I've got fixed income. So the growth component of the portfolio is the stock side of things, but we also own bonds, because bonds, especially when people are taking money out of their portfolio, they provide stability. Stocks, they don't just go up in a straight line. Over time, they go up. History has proven that. But we have periods where they go down in value. We saw that earlier this year. So far, I mean, we're on track to have a very good year, but there are periods of volatility, and really it's downside volatility that that we're worried about the most, or that investors are worried about the most. The bond side of things, they're more stable, but they provide a rate of interest. And here's the current interest rates for U.S. government bonds. So that's when you loan your money to the U.S. government, how much interest you're going to pay. And yields, interest has been coming down, which for those that have been following closely to the markets and the Federal Reserve, they have lowered interest rates this year. And so this is a reflection of that. Here's some more categories of bonds. We've got very short-term bonds. So bonds that mature in less than a year. And that's primarily represented here by this red line. Very stable. You can see it doesn't fluctuate much. Whereas these other ones, these are longer term in nature. So the most stable ones are mature very quickly, and they get reinvested, and you get that rate of interest. Whereas the longer term bonds, they have more interest rate risk, so to speak, and they fluctuate. So bonds even can fluctuate in value, but shorter term in nature, you can see very little fluctuation in that. And that's primarily where we have a large exposure or a large allocation to our clients' portfolios in the short-term bonds, especially, again, for those that are taking out money, because we want to have enough set aside to get us through any market environment where we don't want to sell stocks at a bad time. It doesn't happen very often, but it does happen from time to time. Now let's talk about the economy. I always like to update the economic numbers just here, and we follow a very specific pattern here on these charts. And the biggest driver of economic growth, I believe, is our jobs market and the health of the jobs market and the health of the consumer, because so much of what drives revenue for stocks is people spending money. It's consumption, and it's what we as individuals spend our money on, whether it's a product or a service, and that turns into revenue and flows through the financial statements and turns into earnings, and earnings are what drives stock prices. So if we can have an idea of, well, if the jobs market is healthy, if it's trending higher or trending lower, does that give us some insight into, are we headed for continued economic expansion? Are we headed for a contraction? Are we more in a in the middle, where it's not, maybe not a significant expansion, but still expanding, but definitely not contracting? And you can see on this graph here, this is going back to late 2020, and each month the jobs data comes out, and we post, the Federal Reserve posts what the numbers are, and it's trending higher. It's starting to slow down, but it is trending higher. And this is the number of employees here in the United States, almost 160 million employees here in the US. What would concern us, and definitely something I keep a close eye on, is if we start to see job losses, and that, and I say that from the aggregate level, meaning it's not just one company or one industry that's announcing a layoff. We're looking at across the board, is the entire economy either adding jobs or contracting or shedding jobs. And if we start to see more job losses, and definitely a negative announcement on a month-to-month basis on, hey, the U.S., for the first time in however many years, had lost jobs this month. Now, one announcement isn't the end-all be-all, but it's the beginning of potentially a trend lower, and that's where we will start to keep a close eye on when we see those announcements. This is job openings here in the U.S. So these are companies that have indicated that they're still hiring. Again, this goes back to 2015. These are graphs from directly from the Federal Reserve, and they have a very similar format on them, with time being at the bottom, and then the units on the left or right side here. But if you see a gray bar in any of these graphs, that represents a recession. And the length of it, or the width of it, is how long was that recession. So this is the COVID recession, which was very short. And you can kind of see, okay, well, what impact did that have? Well, we had a lot of job openings pre-COVID, and then during COVID, well, yeah, people weren't hiring. And then the aftermath of COVID is, okay, we need a lot of workers. And all of a sudden, demand for workers just went through the roof for the next couple of years, which had some impact. It increased wages. It increased prices too, because people and companies are like, hey, we need more employees, and to attract them, we might have to pay them more. And so when wages go up, typically we see inflation follow, which is one of the things that we saw kind of post-COVID. Now, over the last few years, employers have slowed down their rate of hiring, but we're still seeing companies at slightly above the pre-COVID levels of job openings. So this is definitely not, it's slowing down, but not indicating that companies are at a, hey, we're at the phase of we want to lay people off now, versus still wanting to hire. This is a good indication of future hiring. This also, this graph here is when employees first, when they get laid off, they file for unemployment, and this is continued claims of unemployment. So this is when people are on unemployment for long periods of time. This goes back kind of right after COVID ended. So this is why this graph comes way down, because there was a lot of people that were on unemployment during COVID and post-COVID, and then as they got back to work, this graph reflected that. And what we look for here is, again, are we seeing trends higher? And yeah, I mean, it's definitely trended slightly higher over the last few years, but it is not at hey, we need to. This isn't at a red flag territory at this stage. But again, something that we like to pay attention to make sure that the economy is still growing and expanding, because again, that can give us some insight into how the stock market may perform and how interest rates may react in the future. Retail sales have still trended higher. That's actually been something that's I think a surprise to a lot of definitely a lot of analysts and a lot of economists, because we've had the tariffs come into play this year. And yes, while there's been definitely some clarity around some of the tariffs, it's still still a headwind when you have a tariff and prices increase. That hasn't slowed people down from spending, and I think that is really more of the surprise that people and economists and analysts were not expecting. This is building permits. So when businesses or when builders file permits for new housing, and it's definitely slowing down. Demand for housing is slowing. It's a function primarily of the cost of housing, which is two components to that. You've got just the purchase price, because houses are expensive and they've gone up a lot over the last few years, but also the financing costs too. Interest rates are higher. They're starting to come down, but they're still higher, and they're higher than where they were a few years ago. And there's this anchoring effect. When people, well, they remember, because it wasn't that long ago, 3-4 years ago, you could get a 30-year mortgage for 3.5%, 3%. I mean, in some cases, they were as low as 2.5%. And now they're in the 6.5%, as high as 7% I've seen over the last year or so. And people anchor to that. They anchor to the old number, and they want that number. They want to, I mean, everyone wants to get a 30-year mortgage at 3%, but it's just not where the market's at right now, not where interest rates are at. May come back down to that level. We'll see. A lot of things would have to come into play for that to happen. The Federal Reserve would have to lower rates significantly. You'd have to see some I think some more of a economic slowdown for interest rates to get that low. But we'll see how that shakes out and what impact that has on the real estate market. This is business spending. So this is what businesses are spending money on. So we've got consumers. They're the biggest piece of economic growth here. What they spend money on. That's 70% of our GDP is driven by consumption, and about 20% is driven by business spending, and then the rest of it is combination of government spending and what the impact of imports and exports. And right now it's a negative, because we import more than we export when it comes to GDP. But when you look at business spending and consumption, those are the two biggest components to spending or to GDP growth. And business spending, while yes, spiked post-COVID, it's not showing a slowdown. Businesses are still spending, and they're spending a lot on AI and kind of the CapEx spending related to that. And I have some I had some questions related to that, so looking forward to discussing that as we go through today's webinar. And then lastly, this is interest rates, but this is the yield curve, and currently we've had a inverted yield curve, meaning short-term rates are higher than long-term rates. Doesn't happen very often, but when it does happen, that can lead to economic contractions. And the reason that exists is because when short-term rates are higher than long-term rates, it's considered a tight money supply, meaning it's harder to get financing. The cost of financing is increasing enough, and the Federal Reserve's trying to slow things down and put a damper on inflation. So they raise short-term interest rates, and sometimes they raise them quicker than long-term interest rates can react to it, and that's what this inverted yield curve means when that happens. And I've highlighted times in the past when we've had inverted yield curves, and you'll notice they all happened. We had an inverted yield curve prior to a recession, except the last few years we've had an inverted yield curve and we haven't had a recession. And I think there's a lot of factors that kind of play into that, and the biggest one being the Federal Reserve. They've been very active in the yield curve, meaning they're out there buying short-term bonds, and they did this a lot kind of post 2008 with their what they called quantitative easing. So they're trying, at that time they were trying to keep interest rates low, so they were artificially increasing demand by buying bonds, which will keep interest rates low, and putting capital into the market. And over the last few years, they've been reducing that, so interest rates have been creeping higher. So it's less of a reflection of economic conditions, more of a reflection of the Federal Reserve and what they're doing to impact interest rates. All right, let's talk about earnings. This, I believe, is one of the favorites of most folks when they watch my webinars. They like to kind of understand the earnings, where they're at, where the projections are at, and then the market multiple that goes along with it. So here we've got earnings. This is going back on the left-hand side of the screen, last few years, and this is aggregate earnings for the S&P 500. So the S&P 500 is, it's 500 companies, and it's a benchmark of the performance of the U.S. stock market. And you've got those 11 sectors that I showed earlier represented in the S&P 500. And there's weightings to each of the companies. And the way the S&P 500 weights the index, the people that govern the S&P 500, they weight the companies based on market capitalization. So what that means is that the higher the value of the company, the more weighting it has in the index. And the formula is the share price times the number of shares outstanding, and that's how they come up with this market capitalization. So the bigger the company is, the more impact that it has on the performance of the S&P 500, and also the more impact it has on the earnings of the S&P 500, because you take, okay, what percentage of the S&P 500 is allocated to this company? What are the earnings of that company? Multiply it by the percentage, and then you can add up all of the earnings for all of the companies and come up with these aggregate estimates. And the main thing is, we want to see this trending higher, and we want to see the estimates trending higher, because the market looks ahead, and current stock prices are really a reflection of future earnings estimates and people's and investors' ability to say, hey, I can see this company's going to continue to grow, or I believe it's going to continue to grow, and I want to own the company today. And then as the company executes and as earnings or growth of the company in market share and revenue and things like that increase, then you see stock prices reflect that. So here we've got the earnings over the last few years, and estimates for the fiscal year of 2026 is $304, and then the quarter 4 2026 earnings estimates is $80.74 a share. And again, why that's important is because it helps us come up with the market multiple, and even more specifically, that Q4 estimate. So as we're entering Q4 2025, stock prices are going to start to reflect Q4 2026 earnings projections. So what we do is we take that Q4 2026 earnings estimate, and then we annualize it. So that'd be $322.96. And then we can take the multiple that the market has traded at, and there's no consensus on, there's no right multiple. It's not like, hey, everyone uses the same multiple. The multiple of earnings reflects people's I would say certainty or uncertainty of the future. So the lower the multiple, the less certain people are on the accuracy of that earnings, or they're not willing to pay up, so to speak. It's like the higher the multiple, the more confident people are that those earnings are going to be realized, and so you're potentially paying a higher valuation, a higher price for that, for that company, versus a company that has a lower multiple, or an index that has a lower multiple. And again, there's no good or bad. It's just when valuations get high or when multiples get high, that can lead to the bubble kind of talk. Like, are investors, are they paying too much for this current stock price relative to current earnings? This is what we saw in the late 90s, where valuations were high, market was overvalued, so to speak. But it continued. It's not like, hey, just because it hits a certain valuation or a certain multiple, that there's a buzzer that goes off and everyone just says, okay, that's too much, and everyone stops. There is no consensus. So while someone might think the market's expensive or pricey or overvalued, that doesn't mean prices are going to go down or stocks are going to go down. It's just a data point. And we do like to look at this because we want to say, well, if we're going to apply a multiple to next year's earnings, where could we forecast the S&P 500 or basically the stock market in over the next 12 months? So we've got, as of the close of Monday, October 20th, the S&P closed at 6,735. And if we apply different multiples to this earnings, this Q4 2026 earnings, we can come up with a forecast for the S&P 500. So if multiples were 18, if people were willing to pay 18 times earnings, 12, currently or 12 months from now, well, that would make the S&P 500 5,813, which is lower than where it's at today. A 20x multiple, 64.59, 22 multiple, 71.05, and a 24 multiple, 7.751, which is kind of where current multiples are at. If we look at current earnings divided into the S&P 500. Well, looking at that range from 18 to 24, that gives us, a range of stocks could be as they could be down 14% or as up as much as 15% over the next 12 months. And they could be up or down more than that. That's just a range based on these current multiples that I believe are appropriate based on where we're at. Now, I think based on where the economic data is and where where earnings are at and where earnings are currently coming in, that we're going to continue to see this increase, and we're going to see the market trade at this 22, 24 times earnings over the next 12 months, which would give us this positive rate of return. If we started to see an economic slowdown, so if we start to see job losses, well, then that's when the multiples potentially will start to come down, because then the earnings forecast will start to come down. People aren't willing to pay as much for those future earnings, meaning the valuations would come down, multiples come down, and stock prices would come down. So we will, of course, update this as data changes, but this is the trends and what we see in the current economic data. And this is, again, I believe we're still going to be on the positive side of this. Let's talk about interest rates too. So, current interest rates are around 4%. And the projection by the end of the year is that the Fed will reduce rates to about 3.5. So that would be a 50 basis points, or what they would call 2 rate cuts by the end of the year, because a lot of times you consider a 0.25% as 1 rate cut. So even if it only happens at 1 meeting, that would still be 2 rate cuts by the end of the year. And that's what the market is expecting when it comes to interest rates. And the way this this is factored in is that there's futures and investors, traders, they buy futures markets where they think interest rates will be, and this is a reflection of that. So let's go into what I believe are the key issues, the key questions for the remainder of this quarter and as we enter into 2026. And a lot of these were driven by the questions that I received from everyone. Hey, what about this? And what's the impact on that? So when we think about, when I showed that chart, we've had a great year so far, and definitely a strong rally since those April lows. And a lot of it's been driven by AI and the enthusiasm related to AI. Also, the expectation that the Fed is going to lower interest rates, which can be seen as a positive for markets. We've still had good economic growth, continue to add jobs, retail sales are good, businesses are spending money. Those are all good things. And the tariffs have not slowed things down. That's, I think, the biggest surprise so far, is that prices have gone up definitely on things that are imported, and people are still spending money. They're not cutting back. But there's uncertainty around a lot of these different things, and these are the questions that I received. So let's talk about AI, because there was a lot of questions on, is AI, is that a bubble, or is the market in a bubble, just generically? But when you look at the financial news and the financial media, there's been this bubble talk, I think, over the last several months, and definitely around AI and how that's all working. And two, if the Fed is not going to cut rates as much, then will that impact things? Will the tariffs eventually start to have an impact? Now there's some Supreme Court decisions that'll be coming up here that will have, have definitely a lot of attention drawn to them, because I think that will give us, again, some more clarity on the future of tariffs. Let's talk about AI though, and what that looks like. That'll be the first thing that we're going to go over. And what we've seen in again the last 6 months, but we've seen this over the last several years too, that these semiconductor companies, the data centers, the networking, there's these deals between OpenAI and these different businesses, and there's deals between the chip makers and different businesses, and it's like, well, what really is going on with that, and is that sustainable? Well, we're seeing so much money go into AI infrastructure because there's significant demand for AI and more AI, I guess, computing, if just to keep it simple, and you need these data centers to be able to handle all that, and these companies are spending a lot of money on these data centers, and there's a boom in that area. I know a lot of the clients that we work with that are in the construction, engineering, architecture space. They're seeing a lot of business from these companies on that. And you got to connect the the power, the transmission lines, everything. There's so much that goes into building out these massive data centers. But the other thing that we're seeing too is that AI spending has a very short, or the investment definitely on the chip side and the computing side of AI has a short life cycle. So there's a lot of reinvestment that needs to continue to happen. So even though you might have upgraded everything last year, you might need to replace a lot of that or upgrade it again next year or the year after, because it's changing so much, and the computing power needed to continue to run these different AI models is it needs to keep up with the ability to run these models. But what we're seeing is, even though we're seeing some significant price appreciation, valuations aren't in bubble territory, and it's because earnings are keeping pace. That's an important piece. So that's where that valuation, that multiple, as long as earnings are continuing to increase, then those multiples can maintain themselves. It's when we start to see deterioration in those earnings, and companies are spending too much money, but they're not getting a return on an investment with that, and you start to see a reflection in their earnings, that those multiples can come down. And we can even take it to a more specific asset sector level, or even a subsector, subcategory, where you can look at what the valuations are of tech companies versus utilities, and come up with some analysis related to that. But I don't believe AI is in a bubble, because, as I just mentioned, the earnings are keeping pace, and earnings guidance has been positive, but we need to, again, continue to see earnings results, not just guidance. But if we do start to see slowdowns in this CapEx spending, that could start to deflate some of it, because then the businesses aren't spending as much money as maybe the projections were, and now you start to see that reflected in earnings as well. Well, now what about economic growth too? That's another thing. It's like, well, I showed the jobs market, and it definitely showed signs of slowing. I would say not contracting, but definitely signs of slowing. But then we break it down into different areas. We've got manufacturing jobs, we've got services jobs, and there's a lot more service related jobs than manufacturing jobs. But again, look at it from both those categories, and we're seeing manufacturing stable, starting to slow down, and potentially in what they would consider contraction territory. And again, this is based on surveys. There's an index, and it shows a expansion or contraction, and it's just slightly showing that. And again, these month to month can change, so it's not, it's more of a long-term trend that we're worried about. Now, there's only roughly 10% of jobs here in the U.S. are tied to manufacturing. So it's not as much of a driver of the jobs market, but definitely something to keep an eye on. And the service economy or service jobs are they're still in the expansion territory, slowing, but still in expansion territory. Businesses are still spending money, and they're still reacting positively. And I think a lot of it again is around the AI and the productivity gains they believe that they will realize related to that. And then consumers have been resilient. They've been spending money. Retail sales has been good, and that's even with unemployment ticking a little bit higher, but also with the tariffs related to that too. So while job growth has slowed, we're kind of in this, hey, we're not necessarily increasing our workforce significantly, but we're not firing people either. So again, it's not like, hey, economy's on going gangbusters and on fire, but we're definitely not in the sky is falling territory either. So while economic growth is slowing slightly, it's not entering contraction territory. They're not showing significant drops. Again, that's is why I update these graphs on a quarterly basis, those economic graphs, to kind of see, are we seeing signs of something coming down? Because if we do start to see an economic slowdown, that would inform us. What we look at is, how do we adjust the portfolio based on what could be happening? We could reduce exposure to the stock market. We would talk to all of our clients about this, what we're seeing and what we want to do, and of course get everyone on the same page with this, but also even the makeup of the stocks that we own. Do we own more defensive companies that are more resilient in economic slowdowns? People are going to spend money. They're just going to change how they spend money. They may not spend as much, as I mentioned, on the consumer or discretionary expenses, but they'll still buy the utilities and still buy the staples and things like that. One thing, the big thing for us to watch here is the jobs market. We start to see job losses. We start to see increases in the unemployment rate. Start to see those unemployment claims significantly increase, but also, it's going to be business spending, retail sales too, that will give us some insight into where the economy will be headed. What's going on with interest rates? I think, as I mentioned, 2 rate cuts by the end of the year, and that's where investors are coming in at. But when you listen to the Fed speak about this, and they survey Fed members, they have this thing called the dot plot, and that's a survey of all the people that were on the Fed's committee that determines what they do with interest rates. And it's about 50-50 between 2 rate cuts and 1 rate cut. So there's still a consensus, I think, among the Fed members that interest rates will be coming down, but how much that will be data dependent, as they say, and we'll see. I mean, markets, this is not as significant of a market moving event. This, whether it's 1 rate cut or 2 rate cuts, because we're still talking about interest rates coming down. It'd be more of a surprise if all of a sudden they raise interest rates. That would be a surprise to the market, and that would be a negative for the market if that were to happen. So while yes, highly likely that we're going to see interest rates come down, how much will be, again, we'll see based on the data. I think we're more likely to see only one rate cut because we are seeing inflation data come in closer to that 3% level, which is higher than than the Fed seems to like. But the labor market too is going to impact that if we see more or uh, just less growth in the labor market. I think they might react with more than the one rate cut and do two if they feel that the labor market is potentially slowing down more so than than it has in the past. But I don't think that's going to be a big market mover. I think it'll be short term if there is, because typically the Fed comes out, they cut rates or they raise rates, whenever they have their meetings, and then they have a press conference kind of post that, and that's market will react to what the Fed says, but those can be short term in nature versus long term trend changes. Now, what about tariffs? Are we going to actually get some clarity on tariffs? So in November, what's happening is there's Supreme Court's going to hear arguments related to this International Emergency Economic Powers Act, and those are that's challenging the tariffs. And really what's at stake is there's 165 billion that's been collected so far through customs duties, and that could be refunded to the companies, even though the consumers have paid them via higher prices, but that could be refunded from the government, which would lower government revenue, because they would basically reverse those tariffs that have been in place. I don't think we're going to see a ton of clarity on that, because it's most likely going to be challenged anyway, no matter what happens. So then we're still in this uncertainty. But fortunately, I think anything's going to be short-lived, because we've so far the market's brushed off a lot of the tariff stuff kind of post this April pause. We haven't really been impacted. Stock prices have kind of just ignored it, and primarily because earnings haven't been negatively impacted, consumers haven't been negatively impacted. So so the market really hasn't been too obsessed with needing clarity on tariffs. So to recap, are we in AI bubble territory? I don't think so. Is there are we seeing the labor market forecast a slowdown? No. Will the Fed cut rates by more than 50 basis points? Not by the end of the year, but I think as we move into 2026, we'll probably see, highly likely will be rates towards that 3% range by the middle of 2026. Do we get tariff clarity? No. But the bottom line is the trends are positive, and earnings are good, and that's ultimately all that matters. Do people have jobs? When they have jobs, they spend money. When people spend money, that shows up in earnings, and stock prices reflect that. When that happens, that's all still happening right now, and I think the outlook is good. Here I've got some data. I always like to look at kind of different data points, and we're in the third year of this bull market. So we had the situation during 2020 with COVID. Market pulled back when COVID hit. Then all of a sudden we had a very strong rally into 2020, end of 2020, all throughout 2021. And then in 2022, the market started to go down. Interest rates went up significantly. It was a big surprise. And we saw the stock market drop by more than 20%. So that, by definition, is now we're in a bear market when you have a 20% or more drop. And then when we have a 20% or more recovery from those lows, now we've entered in a new bull market. And that has, as indicated on this graph here, October 12th, 2022 was the start of the new bull market, and we are 3 years into that. And what we've got on here is going back to 1950. All the bull markets that we've had here in the U.S. and the length of them. The average 5.5 years, and the median 5 years. But even on the rate of return standpoint, you've got average 191% increase, median 114% increase, and we're currently at 88%. I think there's still a lot of life left in in this bull market. Again, we're seeing a lot of spending on AI, and I think that's a positive thing. We're seeing companies also from an earnings standpoint, they're doing well, which again is a positive for stock prices. We're also entering the 4th year of the bull market, and historically, how has that performed? Going back to 1950, how has the 4th year been from a performance standpoint? On average, 14%, 14.6%, median 13.7%, higher 85% of the time. And those numbers coincide with the market multiple forecasts that I had, where as we move into 2026, I think we could again still see, as long as the economy is holding up, which I think it will, but we'll update as the data changes. Continue to trade at these valuations, which would support a 14 to 15% forward return from here on the stock side of the portfolio. Well, thank you all for joining the webinar. I appreciate all of the questions that were submitted, all the questions that were submitted even throughout today's webinar. Tune in to our future podcast episode where we will cover those questions. And again, any market questions you've got, you reach out to your planning team, reach out to me. Happy to answer any of those questions that you have. Also, check out our website if you haven't done so, keenwealthadvisors.com. We have replays of the podcasts, our blog posts, webinar replays there on the site. If you'd like a copy of Bill's book, Keen on Retirement: Engineering the Second Half of Your Life, feel free, send me an email, mwilson@keenwealthadvisors.com, or reply to any of the emails that you receive from Keen Wealth, and we will send a book out to you. Or if you'd like us to send a book to a friend, family member, colleague, we can handle that for you as well. Recognized as one of the best financial advisory firms here by USA Today, so very proud of that. A nice surprise that we received, that it was a survey that was sent out, and we were nominated and made the cut for that. And lastly, you can check out our YouTube channel at youtube.com/@KeenWealthAdvisors. We post our webinar replays and also the video version of our podcast you can find there. Again, thank you all for the questions. Appreciate everyone joining today, and we will see you at the next webinar.